I just want to get a sense that what do you think is the biggest cause right now? Is there a demonetization impact on rupee, or is it essentially what is happening to the dollar?
It's actually a sandwich effect which is happening here, because if you look at the Indian rupee and rank it against other emerging market currencies, the Asian currencies, rupee is smack at the middle, which means it has done an average performance. It's neither underperformed or outperformed. It could be partly explained by the factor that Indian bonds have been the best performing bond market since the US presidential election, and Indian equities have been one of the worst performing equity markets in dollar terms. So that's the reason why the effect on the Indian rupee has been quite mixed.
So why are foreign funds buying bonds at the moment? Because is it because they expect interest rates to go down, yields to drop, and bond prices to go up?
In fact, this entire rally which has happened in the bonds since 8th of this month has been primarily on account of the buying by the banks and the domestic institutional investors. FIs has been conspicuously missing in this rally. They have been doing slight bit of profit booking, but the flows have dried up in the debt market.
There's a lot of technicality and the thing about RBI retiring some of the cash, money coming into hand that on its liability being retired, some of it showing up as profits, some of it being retired as the dollar holdings that the RBI has. It's very confusing for people who don't deal with this on a daily basis. What impact does it have on the RBI's dollar reserves, the fact that it holds these in foreign currency at a lower yield? How does it affect the USD-INR equation?
Do you mean to say that the currency which won't come into the system?
The currency that doesn't come into the system, is it likely that the RBI's dollar reserves, which it has to hold either as cash or in the form of, I'm assuming, American bonds or something like that, what happens to that entire process, and what impact does it have on the exchange rate?
Actually, there is a lot of controversy surrounding this, because there is one school of thought which says that because this is basically an accounting adjustment which is going to happen, and RBI cannot abrogate that liability automatically after, let's say, March. So it may stay on the balance sheet as a nominal reserve and continue to be so till the government passes a law and then monetizes it. So it may not have much impact on the RBI balance sheet, except for that it will move away from the currency in circulation. Let's say 1 lakh crore doesn't come in, or 2 lakh crore. That will go out of the heading, which is currency in circulation, and stay in the liability, but come under other reserves as nominal reserve. Okay. So, that not being a free reserve, RBI generally cannot pay a dividend out of that.
Okay, all right. There are a lot of views on that. Okay, I just want to get a sense from what happens to the fact that there is talk about the amount of currency in circulation going down. What impact does that have on the exchange rate, for instance?
The impact overall is positive, because a sudden shrinkage in the currency in circulation is disinflationary, though it may be negative for growth in the short term, but it is definitely positive from the inflation standpoint. And what is good for inflation is good for the bond, and as well as is good for the rupee. That could be the reason why, if you see, after the announcement came on 8th, Indian rupee strengthened initially from 66.70, it went to 66.30 over the next couple of sessions, and then it started to depreciate after the US presidential election results were in. So that tells you the impact of this particular process on the rupee.
Okay, but as we are anticipating that over a slightly longer period, maybe after 6 to 12 months, the interest rates will start dropping quite significantly. If that happens, the arbitrage on interest rate between, on the other hand, we're talking about US interest rates going up, several tightening taking place in FY18, that arbitrage shrinks. So isn't that does that put pressure on the rupee?
Yes, it's a fantastic point. Actually, the interest rate differential is like a ozone layer over a currency. So whenever the interest rate differential stays high, which has been the case all this while, the vulnerability of the currency to external shocks is low. But when that differential comes down, what happens is becomes less expensive for speculators to go and sell that currency. So yes, that increases the sensitivity of the rupee to external shocks.
And so there seem to be many moving parts here and difficult to actually kind of decide what's going to happen. Okay, let's assume that gold imports go down significantly because of the curbs on black money. Does that again have a strengthening impact?
On assuming everything else is constant, yes. Because the imports are down, so naturally your demand for dollars from the commercial sector will be low.
So in terms of, if you look at all these moving parts, and I'm assuming that you are 10 times better at it than any of us can be in anticipating which way it moves. What is your short-term and medium-term call on the rupee right now?
See, at this point in time, the overarching theme for the rupee is going to be what's going to happen to the US dollar overseas, and the biggest narrative which is supporting the is going to support the dollar in 2017. It's already playing out. Is that the push is going to move away from U.S. monetary policy to U.S. fiscal policy. So with Donald Trump being the new president, there will be focus on deregulation. There will be focus on lowering of taxes, and there will be a focus on infrastructure push. Now, all these things means it's good for equities, it's great for the dollar, and very bad for the bonds. So that narrative, in our opinion, would continue at least, say, for the first half. So we can say that US is where India was in 2014 after the new government came in. There are a lot of expectations, and the market reacts on those expectations, and that's going to be the scene. It's going to be the scene till the mid of next year. And as a result of which, the larger theme for the dollar is going to be positive. It doesn't mean it's going to have a straight line appreciation against every currency. Yes, we will get these consolidation phases and also downward corrections. So for the rupee, we can see a measured pace of depreciation, possibly by, let's say, in 1-2 months, we can see levels of 69 or 69, 20, 30. And then over, let's say, 7 to 8 months, we can see even 70 half and 71.
All right. So anyone who's planning a holiday should try and take it in around Christmas and not wait for the summer, it appears. But if, let's say, that the government goes in for a big amount of spending, which it appears to be gearing up for, and the recovery in the Indian economy actually takes place faster. So on the one hand, you see a drop in the cost of capital for corporate India, recovery coming in, and maybe the earnings recovers like a hockey stick, the technical term that they use nowadays. Do you think that a lot of funds will start flowing back into India, and therefore that is an upside risk to the rupee?
True, but if you look at what has happened before the demonetization started, let's say if we just go back to November 7th and before, Indian rupee, the Indian economy was doing absolutely fine. India was still an attractive destination relative to other emerging markets. So even then, the rupee's outperformance was being shown in relative to other emerging market currencies. So we were depreciating against the dollar, but in a very at a measured pace, and also at a slower rate than what other emerging market currencies were doing. So if we get back to that kind of a run rate of growth with the after the government stimulus and etc., that particular trend is not going to change. If the dollar is depreciating, the dollar is appreciating internationally, Indian rupee has to follow suit, but we will do it less than what the other currencies would do.
Okay, leaving aside the rupee for a while, just give us a sense as to what you're expecting in terms of the dollar euro, the dollar pound equations.
Dollar euro, all these currencies are going to be under pressure till the Fed, which is on 14th of December. Now, Euro is a special case because now what has happened is there are a number of political events in the Eurozone, starting with the Austrian presidential election first week of December, which is expected to go the right-wing way. Then it is going to be the important Italian referendum. Now, this event is being watched quite actively by the Euro traders, because in case the government loses the referendum, they may fall, and that's what the opinion polls are suggesting. Now, we all know how the opinion polls had a very bad year in 2016. So, in case the government wins the referendum, it's going to create a good upside for the euro, and we can see levels of 1.12 also against the dollar, which is going to be a larger positive for the EMs as well, because if you have a scenario where there is a less risk for the eurozone, is going to have a salutary impact on the EMs as well.
And the fact that the yen is, we've seen the yen actually depreciate quite fast, lose value against the dollar very quickly. What impact does that have on things like the yen carry trade, for instance?
Yen carry trade at this point in time is not working out. It's been for the past almost like a year or so, yen carry trade has been missing. So because for the simple reason that people have been much more focused on what the trend of the dollar is. So as long as dollar is strengthening sharply, people are not wanting to own emerging market assets. And it's not just the dollar which is strengthening. It is also things like LIBOR is rising, so which is the dollar cost of funds. So both together, that makes yen carry trade unattractive as far as the EMs are concerned.
Right. All right, Anindya Banerjee, thank you so much for coming in and speaking to us. Pleasure talking to you.